Imagine this. You worked your entire life, saved money, trusted the system, and now, in retirement, small changes you don't even understand are quietly taking money away from you every single month. Not because you made a mistake, but because you didn't know the rules changed. In 2026, something very important is happening inside Social Security, Medicare, and taxes. And most people have no idea. In this video, I'm going to break it down in the simplest way possible. No complicated jargon, no confusion. Just one goal: to make sure you don't lose money that is rightfully yours. Let's start with what everyone talks about, the increase. In 2026, Social Security benefits are expected to increase by around 2.8%. Sounds good, right? More money every month. But here's the truth. Nobody tells you. That increase might actually push you into higher cost brackets. Yes, you heard that right. You get a slightly bigger check, but your Medicare premiums, your taxes, could also go up. So instead of feeling richer, you might end up keeping the same, or even less. This is what I call the illusion of increase. And if you don't understand this, you could lose money without even realizing it. Now let's talk about something very important, especially if you're still working. Many retirees today are not fully retired. They work part-time or have some income. But here's the catch. If you earn above a certain limit, Social Security starts reducing your benefits. For example, if you haven't reached full retirement age yet, there's a strict income limit. Cross that limit, and part of your benefit gets withheld. Now don't worry, that money isn't gone forever. But in the short term, your monthly cash flow takes a hit. And most people don't plan for this. They think, I'm earning more. I'm safe. But reality? They're unknowingly triggering benefit cuts. This is why understanding the system is more important than just earning more. Now this part is actually good news, but only if you know about it. For years, many people, especially teachers, police officers, and government workers, were penalized because of two rules called WEP and GPO. These rules reduced their Social Security benefits, even though they had earned them. But now, things are changing. These penalties are being removed, which means some people could see higher monthly payments and even receive back payments from previous years. But here's the problem. Most people don't even know they qualify, so they never check, never claim, and they leave money on the table. Imagine losing thousands just because nobody told you. Don't let that be you. Now let's talk about the biggest silent expense in retirement: healthcare. In 2026, the base Medicare Part B premium is around $200 plus per month. But here's what most people don't realize. This amount is automatically deducted from your Social Security check. You don't see it leave, but it's gone. And for many people, this is just the starting point. If your income crosses certain limits, you pay even more. So while you're focused on your benefit increase, healthcare costs are quietly eating into it. This is why many retirees feel like, I'm getting money, but I still don't have enough. Because the system is designed in layers. And unless you understand those layers, you can't protect your income. Now I'm going to show you something that almost nobody talks about. And this one rule alone can cost you thousands. It's called the 2-year lookback rule. Here's what it means. Your 2026 Medicare premiums are not based on your current income. They're based on your income from 2024. Yes, 2 years back. So even if you retired today, even if your income dropped, you could still be paying higher premiums based on your old income. And here's where it gets worse. There's something called the $1 trap. If your income crosses a limit by even $1, you get pushed into a higher bracket, and your monthly costs can jump significantly. We're not talking small numbers. This can cost you over $1,000 per year, all because of one extra dollar. This is how the system quietly takes money, without you even noticing. Now let's understand how those extra charges actually work. This is called IRMAA, Income-Related Monthly Adjustment Amount. Simple meaning? The more you earn, the more you pay. Now on screen, you can see different income brackets. And each time you move up, your Medicare premiums increase. But here's the dangerous part. These jumps are not smooth. They're sharp. So going slightly above a limit can suddenly increase your monthly cost by a lot. Most people don't plan for this. They only look at their income. They don't look at which bracket they're entering. And that's the mistake. Because in retirement, it's not about how much you earn. It's about how much you keep. Now this next part is emotional and very real. It's called the widow penalty. When a couple files taxes together, they get higher income limits. But when one spouse passes away, the surviving partner has to file as single. Now think about this. Same income, but suddenly lower thresholds, which means higher taxes, higher Medicare premiums, at a time when emotional and financial stress is already high. This is something most families never plan for. And when it happens, it hits hard. That's why understanding these rules early is not just financial planning, it's protection. Now here's the most important part so far. What should you actually do? Because awareness without action is useless. Step 1. Audit your taxes. Look at your 2024 tax return. Step 2. Calculate your income properly. Not just salary, but total income that affects Medicare. Step 3. Cross-check your income with IRMAA brackets. This one step alone can save you thousands. Because once you see where you stand, you can make smarter decisions. You can control withdrawals. Adjust income. Avoid crossing those dangerous limits. Remember, the system doesn't warn you in advance. It sends you a bill later, so you have to act before it happens. Now let's talk about smart strategies. Because this is not just about avoiding loss. It's about keeping more of your money. Two powerful tools, Roth IRA and HSA. Money you withdraw from a Roth IRA is generally tax-free. And most importantly, it doesn't increase your taxable income in the same way. Which means, it may not push you into higher Medicare brackets. Same with HSA. Used for medical expenses, tax-free. These are not loopholes. These are legal strategies. But here's the truth. Most people learn about them too late. After they've already paid extra. After they've already crossed limits. So don't wait for that moment. Plan early. And protect what you've worked your whole life for. Now let's go one level deeper, but I'll keep it simple. There are ways completely legal to reduce your taxable income. One powerful option is something called QCD, Qualified Charitable Distribution. If you're above a certain age, you can donate directly from your retirement account. And that amount is not counted as taxable income, which means lower taxes, lower Medicare premiums, and more control over your money. Another example, home sales. In many cases, a large portion of profit from selling your house can be tax-free. But here's the key. It's not just about knowing these strategies. It's about timing them correctly. Because one wrong move, and you trigger higher taxes instead of saving them. That's why planning is everything. Now this might be the most underrated step in this entire video. If your income has gone down recently, you don't have to accept higher Medicare premiums. You can appeal. There's a form called HSA 44, and it allows you to tell the system, my situation has changed. Maybe you retired. Maybe you lost a spouse. Maybe your income dropped. And because of that, you can request lower premiums. But here's the problem. Most people don't even know this form exists, so they keep paying more, month after month, thinking it's normal. It's not. Sometimes you're overpaying, simply because you didn't ask. Now let's talk about something that shocks most people. Social Security can be taxed. Yes, the money you already earned can be taxed again. And the worst part? The income limits for this tax haven't been properly adjusted for inflation in years. So what's happening today? More and more retirees are getting pulled into this tax without even realizing it. This is what many experts call the stealth tax. Because you don't see it coming. You just notice. Your money isn't lasting as long as it should. And you start asking, where is it going? This is where it's going. All right, let's simplify everything into a clear action plan. Here's what you should do after watching this video. First, understand how the 2026 increase affects your total income. Second, check your 2024 tax return carefully. Third, see which Medicare bracket you fall into. Fourth, use strategies like Roth withdrawals or QCDs wisely. Fifth, if your income has dropped, file that HSA 44 appeal. And finally, stay aware, because small changes in this system have big effects on your money. You don't need to be an expert. You just need to be informed. At the end of the day, retirement is not just about how much money you have. It's about how much you keep. You've worked for decades. You've sacrificed. You've done everything right. Don't let small rules, hidden costs, and lack of awareness take that away from you. Because the system is not going to remind you. It's not going to warn you. You have to take control. And once you understand these rules, you are no longer confused. You're in control. If this video helped you even a little, make sure you share it with someone who needs this. Because a lot of people are losing money, not because they made bad decisions, but because nobody explained this to them. And if you want more simple, real explanations like this, subscribe to the channel. Because here, we don't just talk about money, we help you protect it.